This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey, Jason, I just want to say this. Your presentation in Tampa was one of my favorites. I have been sharing that slide that I took a picture of with just about everybody I know about price of housing versus gold per ounce. Man, just incredible.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Greetings, empowered investors. You know, we all have some leaks in our ship. Some things where money is just draining out of our pocketbooks. And how can we solve this? Have you ever thought about what is your biggest leak? What is draining your wealth? Well, for most of you, not me, fortunately, and hopefully not a lot of you, but probably for most of you still, it is taxes. And today we are going to talk about how to save money on life's single largest expense for most people. And before we get into that, I want to share a couple quick thoughts with you, a couple interesting graphs and charts that I got to talk to you about. So here we go. You already probably know about the great news about the Fed rate cut, and better yet, I got some even better news for you. The bond market is pricing in 2 more rate cuts this year. Well, think about it. We've only got a couple more Fed meetings this year, so it looks like we're going to see a couple more rate cuts this year, and even better, they are pricing in 3 more rate cuts for next year. The bond market is an incredible predictor of this stuff. It's not perfect. Of course, things could change, but that's what the bond market is telling us as of yesterday. So that's great news. Millions of people will be able to qualify for the median price home if we see mortgage rates go down 0.5 point, and if we see them go down a whole point, over 5 million new potential buyers moving into the market, in a market where we've got just slightly over about 800,000 homes for sale. That's a big deal. You know what that means? That means bidding wars. That means multiple offers. I know there's a lot of other things going on in the economy, of course. It's a very complicated thing. But from a real estate perspective, we've still got relatively low inventory, even compared to the more recent years, but certainly historically very low inventory. And we have got many more people coming into the market. A lot of pent-up demand, a lot of millennials and Gen Zers who are living at home way too long. They're going to move out. They're going to form their own households. We've got about an undersupply of buyers in the market over the last 2 years of about 2 million per year. All these people that have been putting their life on hold, all their plans on hold, they're going to move into the housing market. And that's going to be really good for prices. But the trick is, as an investor, you need to be there first. You got to be there before them. Because if you're late in that game, in that cycle, then you're going to pay a higher price and you're not going to get the best cut of the deal. I have news for you. I just bought a home, a personal residence here in Arizona. Very excited about that. Doing an inspection here in the next few days and have a lot of contractors that I'm going to be meeting with. Oh, I dread the idea of doing a home remodeling job. But you know, this is a market where you can't really buy newer homes in a lot of the prime areas because it's just been built out, you know? So this house has a terrific floor plan. It's got an incredible location. It's really a trophy location. All I got to do is update the interior. No major remodeling. I don't have to move any walls. Fantastic floor plan, but it's out of date. It needs to be updated. So anyway, I will be, of course, informing you of how my project is going and probably complaining over the coming months. So get ready. Anyway, those rate cuts are coming. So that's great news for all of us. Okay, now I am showing a chart for those of you in audio. I am showing a chart of owner-occupied real estate assets versus liabilities. And this is the best it's ever been in history. It has never been better than this in terms of how much equity people have. In these owner-occupied homes, first of all, the value of owner-occupied real estate in America is nearly $50 trillion, and the liabilities are so low. They are just over, according to this chart, this is about 14 million. That's actually lower than the last time I talked about this, where it was, I think, about 19 million. So people who own existing homes are extremely comfortable. There is just no distress. In fact, I was reading the foreclosure reports from the last month, and foreclosures are down. There's hardly been any going on in America for years and years, but they went down last month. Okay, even fewer people in distress. There's always a few people in distress. That's the way the market works. But we've got like 17 people in the country on the verge of foreclosure. I'm just kidding. That's a fake number. But you know what I mean? It's like a non-event. It's a nothing burger. There's just nothing going on in the foreclosure market to speak of. It's almost non-existent because people have so little distress and they are so comfortable, and the homes they have with their COVID era interest rates and 42% of them having no mortgage at all, they're not in distress. And hey, doomers, I'm sorry. If you want to have a housing crash, the one ingredient you absolutely positively must have is tens of millions of existing homeowners who are very distressed, and they become millions of distressed home sellers. Right now, and for the past few years, just as I predicted, we have the exact opposite of that. We have tens of millions of people who are extremely comfortable with their situation, and they ain't selling. So that's it. That story remains the same. As Led Zeppelin would say, the song remains the same. The song remains the same. All right. And the iBuyers, the institutional investors, they're buying up properties. Open Door, 11,985 homes purchased. New Western, 4,600 homes. OfferPad, 2,400. Actually, a little higher than that. I'm just rounding. Invitation Homes, another 2,200 homes. Net Worth Realty, 2,100 homes. American Homes for Rent, just over 2,000 homes. Amherst, 1,450 homes. These are new acquisitions. Truehold, 1,253 homes. And Pretium, 1,252 homes. So if this is the smart money, folks, you see what the smart money is doing. All these Wall Street firms, they have economists on staff. They have housing market analysts on staff. They subscribe to all of the expensive forecasting newsletters and groups, and they're buying. Maybe, just maybe, you should follow their lead. And you're certainly going to have the opportunity to do that this weekend. We look forward to seeing you Friday evening at our Phoenix Jason Hartman University event and property tour. We're going to be looking at great deals on brand new homes, and we're going to be looking at great deals on co-living opportunities. The first time we've presented co-living, we will sell no wine before it's time over here. And I have waited to introduce this to you for about 5 years. I've been putting it off because I didn't think it was ripe. And now I think it's ripe. So we're going to be seeing that. We're going to be having a great time. We start Friday evening at 7 p.m. for just an informal reception, have a drink, have a snack, and hang out and chit chat. But 8 a.m. Saturday morning in the hotel ballroom in Chandler, Arizona. We will see you there. We're going to do education for about 4.5 hours. We're going to do our working lunch at the hotel. We're going to get on the tour bus at 12:30. These times are slightly approximate, of course, a little bit tentative like anything. And then we will tour home Saturday afternoon. We'll come back. You'll have the chance to freshen up. And then we will be meeting for dinner at 7 p.m. We're going to be celebrating yours truly's birthday. And that'll be a lot of fun. I hope another year older, another trip around the sun, right? Then Sunday morning, 8 a.m. And, Saturday afternoon, we'll probably finish up by about 3. I don't know. We'll see how it goes. And we'll see how many questions you have from all of the great stuff we've discussed. But it's going to be a great time. So we'll look forward to seeing you this Friday for those of you coming to Jason Hartman University and our property tour. It's going to be great. Okay, and a couple other reminders. Use our AI chatbot. That is a clone of me. You can get all your questions answered 24/7. This is going to take my job, folks. So use it. Take advantage of it. It's totally free. Go to jasonhartman.com, and down in the lower right corner of that page, you'll see our little superhero. That is our AI chatbot. You can go directly there and maybe bookmark this page, jasonhartman.com/AI. Trained on 1,800 plus of my podcast episodes, my YouTube videos. So anything we've ever discussed on these forums, you can get answers to that, plus have the whole power of the internet as a backdrop. It's incredibly powerful. It's really very, very useful. And since I mentioned it last week, a lot more of you started using it. And those who are using it, we notice you keep coming back over and over. Every couple of days, you're on getting new questions answered by my clone. So you can find my clone at jasonhartman.com/AI. And our Wednesday Masterclasses are always going on. That series, you can subscribe to it at jasonhartman.com/Wednesday. Join us for those every month through thick and thin. We will be there for our masterclasses the second Wednesday of every month. And we have a tax expert today, an enrolled agent. And, sometimes enrolled agents kind of know more of the technical stuff in the tax code than the CPAs do. They both have their strengths and weaknesses. I've used enrolled agents to do my taxes over the years, and I've mostly used CPAs. But you just get kind of a different perspective from each of them. So I definitely like talking to each of them. And today we've got an expert who's going to talk about saving you money on taxes. So now let's get to our guest. It is my pleasure to welcome Jack Evans. He is the founder of Jack's Tax. He is an enrolled agent. And I want to discuss some of the differences, maybe to start off, between CPAs and enrolled agents, because one may know the tax law better than the other. So we'll dive into that. Jack, welcome. How are you?
I am great, Jason. Thank you for having me on.
It's good to have you. So let's go ahead and address that right out of the chute. We're going to talk about some great tax strategies for real estate investors. Can't wait to dive into that. I've looked at your slide deck. Talk about the difference between CPAs and EAs.
Many years ago, the IRS, the Treasury, decided that it needed to train tax preparers in actual just tax code. And they created the Enrolled Agent Testing Series, which basically is a series of exams that is extremely similar to the CPA exams. The difference is they're administered by the Fed instead of the states. So all CPAs are licensed by state.
Right.
And I'm licensed by the Fed. And the one chapter of the test that is not on there is the audit. Audit meaning going into your business and digging through your books and camping out for 2 months.
Right.
That's
CPAs
the part that
do that. Yeah.
Right. And enrolled agents generally do not do that. I'll still go through your stuff and tear it apart, but I'm not going to come to visit you. And that's where I do not invest my time in that. I invest my time in tax code and tax law.
Right, right. So, it's arguably enrolled agents actually know the tax law better than CPAs because they're specialized in literally just that one thing.
Arguably. I'm definitely not distracted by wondering why one of your business officers is moving money in the wrong way and putting it in the wrong category.
Right, right. That's what auditors do.
Right.
Okay, cool. Well, let's go ahead and dive into it. For those of you listening on audio only, Jack, please explain any visuals you share with us, and let's go ahead and dive in.
I'll see how I can do it for you. Yeah, Jack Evans from Jack's Tax, and the kind of how I look at this is I am a real estate investor myself. I've got multiple single-family rentals in multiple states for different reasons. And I just kind of go where my dollar and my real estate's treated the best. And I attempt to keep moving with that and stay abreast of that. And today we're going to talk about depreciation a bit. Some of you guys have read the Rich Dad, Poor Dad and things like that. And he kind of lays a very loose framework about how this all works. But depreciation is the the shadow of savings. So basically, you have your asset depreciated over 27 and a half years. These are all just for long-term rentals, by the way. And long-term rentals are able to, they are considered passive. You got to keep that in mind, meaning that we all know they're not passive because you're generally doing a lot of work.
Yeah, well, nothing is passive. I always argue that there's no such thing as a passive investment, but
Right.
as the classification, the IRS calls this passive income rather than active income. And so you get to depreciate it, the structure, over 27.5 years, commercial
That's
real
right.
estate 39 years. And I always say, Jack, that depreciation is the holy grail of tax benefits. It is
It
the
is.
best tax benefit going because if you want any other tax benefit, you pretty much have to write a check, donate some money to charity, expand your business if you have a business, and then you'll get a deduction. But here you get a deduction when the property could be performing great. You could be making money and still report a tax loss to the IRS. It's just a fantastic thing.
It does. It reduces today money. And I'm going to clarify what I mean by that in a little while, but it reduces today money. You're deferring paying on that depending on how you want to do this. And this is really all about your investing strategy and how long you want to hold things. And the other caveat to bring up are short-term rentals. We're not going to go into detail, but basically short-term rentals are 7-day average stay annualized over the year. And material participation tests, all kinds of fun stuff. Basically, you are now running a hotel. We are not talking about that today necessarily. I'll touch on it just a little bit, but overall,
running a hotel is active income according to the IRS, right?
Yes.
That's the distinction.
Yep. And those assets are now depreciated at 39 years like any other commercial property. That's where bonus depreciation becomes something that you could take against other income, but that's a different part here. And that's kind of the difference is average stay. Today we're talking about long-term rentals, and anybody wants a further discussion on that, they can follow up with me and book an appointment and chat with me a little bit. So again, we just talked about that 27 and a half years, and that's over the building itself. You got to take out the land. You say, oh, I don't know how much land's worth, but you can simply go to the county and come up with your own number that's logical.
In other words, the tax assessor tells you their opinion of the allocation between land and improvement. In most of our markets, because we like these markets that have pretty cheap land, where the house prices are lower, the rent to value ratios are better for the owner, and they're more linear markets, you're typically going to see about 80% improvement, 20% land. But if you're in
tracks about right.
price
Yeah,
market,
that tracks about right.
Yeah.
And that's just take a look at it.
If you're in a high price market, that could flip and it could be the opposite. So it depends where the property is.
This can get a little sticky with condos and things like that, but that's to be determined with you and your tax pro. Right. So you take out that. So if you got a $500,000 purchase, only $400,000 is going to be depreciated, for example, and just as a simple way to think about it. The issue is what you're depreciating are the integral parts. Room additions, the sticks and the sheetrock and the roof, that's what we're depreciating, and HVAC and everything. And so at some point, we're going to talk about cost seg studies and everything, but those are really going to be kind of issues that we're going to talk about in a few seconds. But overall, everything that's not the core of it, of the shell, is all part of this 27 and a half year deal. And so if mathematically thinking, it doesn't sound sexy to be at 27 and a half years, but it beats the hell out of 39 years. So just don't sweat that part, but we'll get into that in a few seconds. Here's an example, $500,000 purchase, lands 100, so you depreciate 400 grand. And that 27 and a half years, that's potentially 14,500 off of your gains on your income on that one, just to give it a really simplified way of looking at that.
Okay, so just to recap, it's a $500,000 property in this example.
Right.
400,000 is improvement value, and that's depreciable over 27.5 years.
Correct.
And that gives us a potential, and I want to say that, potential tax benefit of just over 14,500 per year.
Right. For full year.
Keep that cash write-off. It's the holy grail of write-offs if you can get it, because it's a non-cash write-off.
And that's per full year. So if you bought it in May, don't talk to me about how it's not the full 14 and a half, but that's the full year number on that, just to kind of get an idea of how to simplify it a little bit. Now, you're limited to 25 grand a year, generally speaking, against other passive income. But the point is, if you have a nice portfolio of long-term rentals, over time, some are going to start making money, and they're going to offset each other nicely and really bounce some more expensive ones against some cheaper ones. And just be really smart about this. And any amounts of money, so you have certain AGI, you don't get to take all your money current year. However, it doesn't go away. It gets carried forward. So if you switch tax pros, make sure you have Form 8582 following with you. Otherwise, you might lose that in the translation. So eventually you will always get this caught up, especially if you liquidate the property. But it's also against other passive income, other styles of income you have going on. So you eventually will use this up. But my point is, you're capped a little bit because these are long-term rentals, but the benefit holds. And the benefit bounces against other rentals, other long-term rentals, other passive income. So keep that in mind. You may not win today, but you're going to win situation. Cost seg studies. A lot of people are hyping about this these days. I don't recommend using cost seg studies in long-term rentals, depending on what you're going to pay. I know Jason has some resources to get it reasonably done. But the bottom line is that you're going to take assets that are 15 years and newer. So you have different year ages on assets. For example, like appliances are 5 years, flooring is this. Those different ages of assets.
Yeah.
When you
Now
do
let me
cost seg,
just explain the cost seg thing a little bit.
yeah,
You have a house or an apartment or any kind of property, right? And it's depreciable broadly over 27.5 years in the case of residential, but
yep,
some of the components can be depreciated faster, which brings you a tax benefit sooner rather than later. And when you get a benefit, you want it sooner rather than later. When you have a debt or a payment, you want to pay later rather than sooner. That's the benefit of a cost seg study. But you're saying that the cost seg study isn't as valuable as people might think, right?
depending on your strategy and how long you want to hold these properties. If you're going to have this thing for 7+ years, 10+ years, it's going to work great because eventually you're going to draw this all down and use it because every year you're making more money because rents will be theoretically going up and everything. It's not a bad idea. If this is a couple year hold, you're just robbing Peter to pay Paul at this point. I wouldn't do it. I wouldn't recommend it for your the value of the money you're doing. And always
Okay,
keep
so in other words, if you don't hold the property long enough, you're just going to pay back this benefit
correct.
when you sell
That's
the
exactly
property
my
too
point.
quickly and have a depreciation recapture
Yes,
because
sir.
you pulled those benefits forward. For us, the vast majority of our listeners are buy and hold long-term investors. And so
Right.
this would be a benefit to them, right?
And I like how you said that, Jason. But the thing is, everybody that has multiple properties has a different mental life expectancy for each property. You have tolerance for certain properties more than others because of how they perform. So just keep it in mind. You're going to have your own prejudices against certain properties and use it wisely
Yeah.
on the darlings, you know?
Yeah. And again, the nice thing is if it's not too expensive, we can get this done for about $550.
Right.
So, it's certainly worth exploring.
And so many of the ones and so many of the promoters out there are charging you significantly more than that.
Oh, yeah. Yeah.
And
Thousands and thousands of dollars.
the value you're going to get is just, to me, there's a cost benefit analysis you need to do. By the way, those are the ones that do get to qualify under the short-term rental loophole that they call it. That's a whole separate conversation and a very detailed one. You're going to have material participation. There are rules for this I can go over personally with people to see if it really works, or be a real estate professional. And the key of the matter is these are very case sensitive to being specific to what you want to do. And I don't know about you, but I am not a short-term rental fan immediately in this day and age right now.
Yeah,
Maybe,
I agree.
maybe it'll come back soon enough.
Yeah.
If anything, I'm advocating to pick some of these up as long terms if you can get them on the cheap. But that's just me talking. Again, my mayor mentioned that these go to 39 years instead of 27 and a half. But the key is, if you are running them short term, you need to have a conversation with your CPA or Jack, that'd be me, and we can, talk it through and see what's really realistic for you. I kind of just talked about that. So I want to go back to the long-term depreciation analysis a little bit. All I'll say is think long and hard about short-term rentals because you're running a hotel. It's a different mindset all the way around.
Right. It's a lot of work. I think it just requires too much attention. Yeah.
And they've had some great people that'll help manage it for you. There's some great tools, but just be mindful that that horse might have left the barn a little bit for now.
Mm-hmm. Good point.
So selling your long-term rental, this is where it all comes down to. You say, we're going to get this depreciation annually, and you're going to enjoy that. It's going to erase some of the same income. And the best thing, if you got 5 or 10 rentals, you're going to bounce it against other ones that are making money. That is the curse of having these rentals, is that you're so accustomed to having that money erased, yet there's money in the account, that eventually you start kind of growing up, and now you're on the plus side. So
when you say money erased, do you mean tax liability erased?
right. The first few years, generally speaking, you're not making any money because depreciation is ahead of the income on the property.
Mm-hmm.
Over time, you're making more rental income and things are kind of angling to your favor over time. Then your interest rate, your interest expense maybe goes down because you're starting to pay some debts down, whatever, however you're going to play it. All of a sudden, you're making money on your rentals. And this is a timing thing. And this is really always looking at your portfolio, which I do with my clients. We kind of talk through each one of them a little bit each year and talk about planning and how you want to do that. Because at the end of the day, if your strategy is to sell it outright, which is not what I recommend necessarily, you're going to have a capital gain on the appreciation and you're going to have depreciation recapture. And those two things, I'm trying to give you an example here. Let's say I held this thing for 10 years, and I'm just going to throw some numbers at you guys. If I'm selling this for 750 grand, this asset, and back in the day I spent 500 5 years ago. Again, over those years, that building value is $400,000. So that's it's a period, it's a 10-year hold, selling for 750. I bought it for 500. Annualized at 27 and a half years, we spoke about that. We have about $145,000 of total depreciation over that time period. So my basis, which is basically the nut that's left in it, is the 500 grand I spent minus the 145, so 354. So I'm walking into this thing with technically a 354 gain, okay?
Mm-hmm.
And how that looks, let me just clarify one thing to remind you. Land is not depreciated. That's why I jumped from 4 to 5. Just remember that part. So overall, when this is all done, 750 minus 354 is $395,000. Depreciation recapture is taxed at around 25%. So of the bill you're going to pay, 36,000 of it is depreciation recapture. It's taxed, but that's depreciation recapture. And the rest is that cap gain, long-term capital gains rates for another 50 grand. Your total tax on this transaction is $86,000.
This is when you sell the property.
Right.
Okay.
Right. That's if you say, I'm sick of toilets, I don't want to do this anymore.
But the thing is, most of the stuff that you're getting in a cost seg study, the benefit you're getting, I'm saying, the biggest benefit comes in about 5 to 7 years. So very rarely would one of our clients be selling before that. I know some of the flippers will, and the people who, are trading all the time. Yeah.
If anything, you're front loading. If anything, you're taking more depreciation now, and you would have more depreciation recapture to take.
Right.
Now, your capital gains are maxed at 20%. That's a cheaper tax bill than 25% of depreciation recapture. This is a calculation. You need to do it and doing it earnestly with your assistant, with your team, to make sure you understand what's going on with this. Because I do not usually advocate to walk away with this tax bill. I'm not a fan of that, because you have these choices: pay the government that money I spoke about, or you can do a couple different things like an installment sale or a 1031 exchange. I'm sure most of you have heard of 1031 exchanges. The benefits of that is that all of that gain is deferred, and you get to reinvest the full amount. The full 750 grand needs to move out, and you get to grow that portfolio. You're going to keep on expanding this. And one way that people say this is that 1031, 1031, 1031, and die. Because then you have a step up in basis, and your heirs are going to be very pleased as they liquidate your assets. But
that is just incredible. That's such a good deal. I mean, as I always say, income property is the most tax favored asset class in America, and taxes are usually the biggest expense in most people's lives.
It is.
Yeah.
And that's they really do. That saying really is 1031, 1031, and die.
Yeah.
So, but sometimes guys got to eat too. So there can be balance of doing certain things. And that's, I kind of give a little example here of the, you sell it for 500 grand and you have 45 days to identify the next property. When I'm starting to prep a property for sale, I will already go out to identify the replacement property. So I'm already 80 days ahead of this thing. So within 45,
if you can. I mean, it's not always possible. It depends on the market, but yes, absolutely. Yeah.
And then you got to lock it up and be done and buy it within 180 days. This usually works quite well. You just got to be ahead of the game. You got to know where the money's going to go before you have the money in your hand. And by the way, it never touches your hand in a 1031. It goes through a QI or a qualified intermediary.
Yeah, we know. Yeah.
But you're pushing that. You're pushing that money. You're not paying any tax on it. And that 86 grand is going to stay in your account and make money for you. Stepped up basis, like I mentioned, which is a great exit strategy. And then the other choice on 1031s, if you're just running out of time, running out of patience, running out of marriage grace to have multiple properties for rentals, you can do a 1031 into a DST, otherwise called a Delaware Statutory Trust.
Now the DST, that's a pretty expensive option. It's loaded with a lot of costs and stuff, right? But I know there are promoters out there, and it is one way to go. You could also do opportunity zones, but the best thing is to just stay in your properties. If you don't like this property, get a different one. But
and hire help. I have people that'll say that they want to get into real estate. I always quiz them heavily and say, how often do you want to be called to be the handy person? Even if you have a handy person helping you out, you're going to be on call.
Yeah, but not in the way we do it, though. Most of our investors aren't buying local properties. They have managers. But we actually, believe it or not, we recommend that they self-manage long distance, and we help them do that. We've done it for years.
Even better.
Great, yeah.
And that's the whole point. But the do-it-yourselfers, I try to say, okay, just so you know what you're getting into.
Right, exactly, yeah. Don't do that because you're not an investor. You're a handyman.
Right, and you got to run the numbers. You don't try to do the work yourself, all of it. You're going to burn out, and you're going to have marital stress if you happen to be married. You just are, man. And build the team. Help get the person that's going to help you manage it on site. Build the tax pro. Get an advisor who has these rentals and the experience to talk you through these and run these models. And then interview, check in with the tenants on your own too, if you have that ability. It is a tax deduction for you to travel to your assets and view them. Maybe talk to the tenant. I like to talk to my tenants periodically. I like to say that people lie to you a little less when there's a face in front of them.
Yep.
But I like to check in with tenants so they kind of know, keep it kind of personal so that it's just not as easy to grift somebody who you feel might be a decent person.
Yeah.
That's not a foolproof policy though, but just so you know. But I really think real estate has helped me to get to where I want to be. It is the right way to go for so many people, and it has so many advantages. And everybody needs a place to live, and is always going to need a place to live. There are so many different ways to do this.
Yeah. And it's the most historically proven asset class in the entire world. There's just nothing better.
And if you get distracted by the comings and goings of the stock market, equities, and everything, just remember volatility. I'll tell you what, a couple back in April and other times, even just during this year, I was pretty happy. I got a pretty good portfolio of land and buildings and dirt that wasn't moving.
I would love to see, and none of our performers calculate this, and I've just never seen anyone really do it. But over time, investing in a real estate portfolio versus stocks or even a business of your own is so much better because of the 1031 exchange benefit. You just constantly get to reinvest free tax dollars. And that is so huge. Every time you trade a stock, if you made money, you pay your gain and then you reinvest. Every time you trade a business, you pay your gain and then you reinvest. Precious metals, same thing. Crypto, same thing. Well, crypto's got a little bit of a distinction on that, but the real estate is the most tax favored thing. And that over the course of, if you ran that pro forma over 10 or 20 years, it's truly unbelievable the difference the 1031 exchange benefit makes. It's incredible.
Not sending money to money heaven via taxes makes your life better. And just as a fun little example, I moved a place a year and a half ago, and I'm not a big fan of the interest rate I moved into, but I 1031 into it. And the point is that I have enough equity, significant equity in this new asset. And when rates drop down, call me in 2 years, I'm probably going to do a cash out refi on this thing. And I'm going to walk away with some cash from the property tax-free.
Yeah. So that's fantastic. We recommend a strategy called refi till you die. That's the most tax efficient way to pull the equity out of your properties. But what's interesting about that, Jack, is that you get the money from the refi. There's no tax on borrowed money. You get to use it. It's fantastic. But the great thing about it with the properties is that the deal you buy is not the deal you're committed to forever. You can turn around and refinance it, take cash out, change the interest rate, change the rental plan, do a lease option. There's so many strategies you can implement that literally change the deal along the way and make the deal better for you. You can improve the property, and raise the income. So
or buy another.
So much
things change and move and shake and or buy another and work your angle. You just don't have to die with one strategy. You get to implement different ideas at different times, and look what gift you're being given. Almost at any time during history, economically, there's a gift being given. You just got to look around a little bit and understand what it is.
Absolutely. Jack, go ahead and give out your website. Tell people where they can find you.
Jack's Tax, which is jax-tax.com. Everybody just kind of jump on my website. That's where you book a 15-minute call with me. We see if we're compatible and we can speak the same language, but jax-tax.com. And I'll be happy to have some conversations and see if I can help out.
Jack, thanks for joining us.
Thank you very much, Jason.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.